Today, I want to talk about two major changes that we are making. One is we've always focused on capital as a major factor that we've always focusing on. So finding the right investors, mm, finding capital for the various businesses, running the fund, etc., which is fantastic, and we want to continue doing that very effectively. We've been very effective with that. We want to continue doing that. And for that, we also have a method for retail investors to um, invest in the strategy. So I'll talk a little bit more about that. But then there is the other side, which we've been hearing about quite a bit over the last few months. Uh, Many family offices, investment firms, PE, VC firms have said one of the biggest challenges that they have is capability, meaning finding the right people, managers, operators, analysts, researchers, etc. Finding the right people to uh, essentially to run this, which is which is very difficult for them. So uh, having a network of around 8,000 investors plus about 1,000 you know LPs on this particular channel, etc. They said, okay, fine, let's tap into our network and let's see where we can help each other. I know many of you might be looking for a job. Many of you might be, you know, say, want to change in the next few months or maybe a year, etc. Then ping me and we can have a confidential discussion. So going into um, the major factors of what is happening with Helix and how our strategy is changing, etc. So over the last week or so, uh, we talked about some of the fundamentally sound stocks that we have been, you know, focusing on. So as an example, um, I think we started off with Bank of America, GE, American Express, Delta, GE Aerospace specifically, IBM, Intel, Nucor, and Keurig Dr Pepper as a um, as a set of fundamentally sound stocks. Again, our focus has been wealth preservation. So these are not the stocks that are likely to surge completely over. These are safe stocks, wealth preserving, undervalued, worth entering into at this stage, and hold on to it for a period of 5 years. So we are not advising people to trade these stocks, make a profit instantaneously, whatever. We are advising our investors to hold on to it because they have the best possible returns expectation over the longer term. Right. So going into investing for the future, this isn't about getting instantaneous high returns. This is more about investing in the trends that will drive consumption in the future. Take Nucor as an example. US based steel maker, green steel. The reason why we are looking at this is yes, fundamentally strong, good, free cash flow, return on invested capital, etc. But very importantly, there is a lot of infrastructure investment that is coming up. And when infrastructure investment comes up, a big part of that spend is going to be in steel, right? And who is best placed, with respect to steel, given all the environmental regulations that are there? Now, don't come to me and say Trump has dissolved all the environmental regulations around the world. No, Trump has done something with federal regulations. Uh, but most of the regulations actually exist at the state level. And most of the incentives also exist at the state level. So, a house builder, industrial farm, manufacturer building a new factory, etc., is governed by various state regulations, not by Trump, blowing his trumpet, right? So, what we have to understand here is many of these things remain the same, or in fact have become more favorable for green steel. So, we are recommending that. Uh, we looked at IBM as a case in point, right? They are well placed in this AI game. So within the AI game, we are not recommending any of the hype stocks. We are only recommending the fundamentally sound stocks. And we took IBM as the case, and where they are placed within that particular spectrum and how they are basically playing to their strengths. Um, it's basically enterprise spend, which which we are looking at, right? So while a lot of the hype has come with respect to the retail related spend, well, these are small numbers coming in, and this could basically fizzle out very easily. What we are looking at is order books that are 5 years, 10 years, and these are large orders, and these keep accumulating for a company like IBM. So that's another one that we recommended. We looked at Intel. While many of you have written back to say, Intel, we've actually written it off. Sorry, don't write it off because it's just coming into into the green, and it's at that point where you can enter that stock, well placed, basically in the sort of cyclical rebound, and hold on to it for 5 years. I think you're going to see a very good momentum with something like Intel going forward. We looked at KDP during Dr. Pepper. So there's two sides to this business. One side is the beverages, Dr. Pepper, Schweppes, Snapple, various other ones like Twinings here in the UK, all that. Right? But the other side is the Keurig coffee machines, which is basically razor and blades kind of an execution. Right? So you sell the coffee machine once, but they keep buying the pods again and again. Uh, it's a defensive staples kind of a play. Again, hold it for the long term, and I'm sure you're gonna make really good returns with that. Um, GE Aerospace, very good order book. Um, you know, it's basically a strong fundamentals, fairly valued sort of a stock. On the banking and financial services stocks, we wrote about two companies, Bank of America and American Express. And then in relation to that, when I was looking at American Express, I also decided to look at Delta. The reason for that is Delta has this co-branded American Express card, and a lot of the um, you know impetus has come in this brand partnership. So Bank of America, fairly valued, uh, fundamentals are strong. I wrote about it last week, or I think the week before. Read through that research report. Again, as I mentioned, we only focus on wealth preservation and reasonable growth. So if you're expecting hype stocks, if you're expecting something to surge today, tomorrow, sorry, this is not the place for you, right? This is the place for investors or in the long term. So when I say long term, look at 5 year sort of a time frame and expecting a reasonable better than market returns by investing in fundamentally sound stocks. So that's the way we run our hedge fund. And the reason why it's a hedge fund is we're bringing in uncorrelated returns, uh, returns that are not correlated to the general market, and that's the fundamental difference that we bring. So look at Delta, look at American Express, look at Bank of America. So all these research reports are available to you already. So uh, then one of the factors that we considered as we grow our AUM is currently we are an English LP and we have some level of institutional access that is there, but many of our investors currently are UK individuals or limited companies, family offices, family investment trusts, professionals, many of them professionals like doctors, etc. Uh, so that's the investor base that we've had. Now, with uh, with a move towards institutional, we don't want to lose this base. But at the same time, what we also want to do is we want to expand the types of capital we take to include retail, right? And to include retail needs a lot of protection, which this high net worth individual group does not need, right? So FSDS, basically a regulated broker, a platform where they can basically buy it, sell it at their own whims and fancies, because retail is fickle capital, right? This is not really long term capital, but it needs that churn and it needs that. So we partnered uh, with a retail partner who can take who can read into our fund, generate an NAV, and uh, as a retail investor, you can go onto that platform, you can buy and sell this one pretty much like any other ETF, right? It's not available through an ISA or a tax saving scheme. It's available around the world, except for US and Canada. It's available for anyone around the world. You will not see the entire uh, 22-month track record that we have on the fund because this platform is new. Right? We only got onto this platform by mid-September. So you'll find a link in my post. So click on that, go and open an account, and basically a brokerage account with. Then um, you can move capital into this, and you can follow our strategy. Just like there are, I think, around 1,000 other strategies that are available on their platform as well. So the reason why we're doing this is for us to scale to an institutional level, we need different types of capital. We want to give that opportunity to retail investors to get onto this, get uncorrelated returns, which they will not get from their fund house, etc. Then uh, we also did another big move, which is basically to go institutional in a very big way. Again, other than US and Canada, I think only US. I think other than US, any other institutional investor, endowment, etc., should be able to invest into this. And for that, we are looking at listing in Frankfurt. More information on this should be coming up in the next 2-3 months. So on our business plan that we made back in 2023, we said 2026 we will go list, and we are on track with respect to that. So early part of 2026, you should hear about our listing and how you can basically get onto this. So we'll be listed in Frankfurt and will be available to Bloomberg and various other platforms as well. Now, as part of my introduction to you know today's strategy review, I said there's two sides to this. One side is capital. Capital can come in and drive these businesses that are aligned to ecoeconomics. Ecoeconomics obviously needs that capital coming in from investors who have a track record of ESG investing. So we obviously need that capital. But what we are hearing from many of the operators and managers is capability is a missing factor. When I say capability is every manager, every GP that I speak with, they say they are looking for emerging managers who are able to beat the market, who are able to deliver uncorrelated returns. They are always on the lookout for new portfolio managers, new traders, new analysts, researchers. always there. You talk to any PE, VC firm right now, insurers, endowments, etc. They are looking for really good operators. Um, so with a network of 8,000 plus uh, of these people, plus about 1,000 of you who are on the Substack as well, uh, what we thought was, why don't we enable this um, for the firms that trust us, right? So how can we enable these conversations? If you are looking to hire, or if you are looking to move in the next few months or a year, then ping me for a confidential discussion. We will note down your profile, understand this. We operate pretty much in three areas. One is executive search. Uh, Second area is on-demand consulting. Essentially, the expert consulting that is needed for managers as well as for operators, funds, endowments, family offices. They need on-demand consulting. We are able to provide that. The third is contract recruitment or interims. Um, so these three opportunities are there. Currently, there are a handful of positions for which we are looking for the right talent. I don't want to talk about the positions right here because all these are confidential roles. So if you are on the lookout, ping me and we can have a confidential discussion. If you have a hiring requirement, just let me know and we can tap into our network and get that fulfilled for you really quick. Um, so that's the other side of the story. And I'm capitalizing a lot on this um, with my co-founder, Sridhar Somasundar, who runs InCube Consulting, uh, a reputed executive search and headhunting firm in London. Um, he comes with over 20 years of experience in this area. So I'm counting a lot on Sridhar's execution capability in combination with my network and this Substack network of 1,000 plus LPs, etc., um, to bring this together and help the firms that are really making the change towards a sustainable future. Now, looking at what is going on in the market right now, right, which is absolutely interesting for all of us. Now, uh, we largely track four major markets: the US, UK, Europe, and India. Among all of these markets, I think the best resilience comes from India. And the reason why I say that is over the last 18 months or so, we've seen foreign institutional investors dump, dump, and dump. And domestic institutions and retail investors in India have been buying, 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 which is basically a vote of confidence for the domestic consumption, right? Just that, not looking at any other factors. There are basically various other factors to look at, but just looking at that factor, it shows that basically the domestic market, the the domestic consumption is going on, and it is essentially there is a vote of confidence for the market, which is something that you must consider if you are looking at investing in India. Then the opportunities are there. If you'd like to talk to us, we have a number of private opportunities that are also available to invest in India. Check sizes of 100K and above. Number of private opportunities that are available. Then looking um, at the S&P, I think one of the major factors that I talked about in the last few weeks, or rather in the last few months itself, is how the S&P has become pretty much of a tech-centric gauge, not a market benchmark itself. The reason why I say that is 35% of weightage on the S&P is for the largest seven or magnificent seven tech stocks. Now, uh, with that, uh, none of those tech stocks are undervalued. This is this is a, this is not news to you. Some of them are valued at 168 times of their earnings, and these companies haven't existed for 168 years. So what you are saying is you're putting in money in there, expecting them to deliver over 168 years, way beyond your own lifetime, way beyond the lifetime of these companies. So there's basically two sides to this, which I keep talking about, right? One is there is a valuation ceiling, and these tech stocks have blown past that valuation ceiling. But then there is a tech ceiling on top of that, right? When that will come down, we can never say. But the tech ceiling is largely controlled by a number of institutional holdings in these companies, right? And we warned you a few weeks ago about how the character of those institutional holdings have changed over the last few weeks to months. Again, repeating that many of these stocks were held by long-term funds, long-term institutions, long-term funds, which tend to, rebalance their portfolio once a year or at best once a quarter. Now, many of that has changed hands into more short-term funds. Though, if you basically look at it, the institutional holdings, 71%, 78% is institutional holdings, remains almost the same. Who among those institutions hold it, and and within that, which fund actually holds it? That is key here because they can execute block trades in a matter of nanoseconds, right? And when that happens, the S&P is likely to face a massive sustained fall. And this is the factor that I keep talking about. If you are an index fund investor, expect to expect to see that sort of a fall. Having said that, if you take out these seven, you have 496 other fundamentally sound businesses within the S&P. Dow Jones, equally, there are a number of fundamentally sound, fairly valued businesses within the Dow Jones. Expand that universe a little bit more uh, within the context. Let's say the Russell 2000 has a number of fundamentally sound, fairly valued businesses for you to look at, which is exactly what we basically write about. In the UK market, given given what is happening with policy um, and with interest rates, I would take more of a wait and watch sort of an approach. And uh, the reason why I say that is there are essentially two factors which um, are sticky. One is uh, there is a large amount of youth unemployment, right? So we get one unemployment number and we think that's just 0.1% higher and it's not much of a problem for me, which is true. But look down that number, you know, the Office of National Statistics provides information within that. And then you find that a lot of that unemployment is under 30 years of age. People in their in the early stages of that career. Why is that a problem? That is a problem of pensions. That is a problem of lifestyle. Our economy is aging. The UK and Europe together, essentially, these populations are aging. The average age in the UK, sorry, the median age is 40, and it is going up year on year. You have you have more number of benefits and incentives being targeted at the older spectrum of that population, older part of that population. And for that to work, you need more and more young people entering into the workforce in full employment, paying income taxes and national insurance. That number is very, very crucial. Now, now nobody tells you this because this is not part of the national dialogue. This is not part of the typical news that you hear, etc. Right? That youth unemployment increasing is a risk to your pensions. So, if you are investing in the future, I would say focus on companies that employ more number of people in the younger age groups. Focus on companies that are selling to these age groups. Focus on companies that have services oriented towards these age groups, right? Under 30 bracket, because that is when you start stimulating this particular process, and thereby you are saving yourself from paying as you age. So unfortunately, your news channels are not going to tell you, your fund managers are not going to tell you this. But this is the reality with the UK, a lot with Europe. The UK has a little bit more pain in this because of Brexit, right? So the reason why I say a bit more pain with that is we had access to a large European market, which was our largest trading partner, and access uh, to a large talented um, pool which we could draw into. That has gone, and now we are importing different kinds of things. We are trying to create trade deals with everybody else after losing the largest market. Now these stresses mean that companies in this market are going to take longer to grow and have that breakaway innovation that we are looking at. Now, having said that, there are a number of innovative companies in UK and Europe, and the fundamental factor for innovation that we look at is whether they are growing despite all these challenges, right? If a company tells me my growth is dependent on regulation, my growth is dependent on, that's not an innovative business model at all. If they are resilient and if they are growing beyond all of these factors, that is where I think true innovation lies. So we are looking at Unite Students, we are looking at Octopus Energy, we're looking at Rolls Royce, uh, UK companies that we are very, very interested in. European companies, there are a number of European companies that we track. We'll be writing about a few more in the next few days and weeks. Stay tuned. All of our research reports have basically a summary up front, which is available to all the free subscribers. And the paid subscribers get our recommendation and our 7 point quantamental model with respect to the earnings. What do you say? Quantamental, there's quant and fundamentals together, which is exactly what you need from an investing journey perspective. Right. Thanks for watching. Uh, watch out for more updates as we go on over the next few days and weeks. You should receive a note about the capability build tomorrow. And if you are in the market, just let me know and we can chat. Capital, obviously, I talked about the retail and the institutional build, etc. So stay tuned. Um, we'll have more updates as we speak. Also, let me know which stocks you are looking to buy, which ones are you analyzing in your comments. Thank you.